Your debt to income ratio has the biggest impact on determining how much home you can actually afford to purchase. So what is your debt to income ratio? How is it calculated? And ultimately, how can you maximize your debt to income ratio to qualify for more home? Well, that's exactly what we're going to discuss in today's video. Now, when we're talking about debt to income ratio today, we're talking about debt to income ratio when it comes to an FHA loan. And the primary reason we're doing FHA is because FHA is probably the most lenient when it comes to debt to income ratio outside of VA loans. But with that, understand when we talk about debt to income ratio today, it's the same exact calculation on every other type of loan program, but the only real difference is that FHA allows you to use more of your income towards debt than any other loan program out there. So what exactly is your debt to income? Well, it's exactly as it reads. It's your debt compared to your income. Now, when we're talking about debt for today's video, we're talking about the things that show up on your credit report. Things like car payments, things like credit cards, things like student loans, any sort of revolving debt, anything that you essentially had to apply for in order to get approved is typically the debt that we're talking about for today's video. We're not talking about how much money you're spending on groceries or how much money you're spending on childcare or how much you're spending on date night. All of those things should be factored into your budget so that you know how much home you can afford, but the lender isn't looking at that. They're just taking your gross monthly income. That's your income before any taxes are taken out. And the reason they're using your gross versus your net income is because people do different calculations when it comes to their taxes. Some people have 0 exemptions, whereas others have 4, 5, 6 exemptions that are taken out of their monthly paycheck, along with things like a 401k or deferred compensation. There are different things that affect how much money you bring home. So in order to keep things equal, the lenders calculate everything based off your gross monthly income. So for today's video, let's use an easy salary to calculate, which is $120,000 per year. So in order to get our gross monthly income, we need to take that yearly salary of $120,000. We need to divide it by 12, which gives us $10,000 a month. So now we have our income. So in order to determine our debt to income ratio, we need to figure out how much debt we have so that we can determine how much home we can afford to purchase. But before we do that, I'd like to take a minute and ask a favor. If you find any value in my videos at all, do me a favor and hit that thumbs up. And if you want to stay updated on content like this, everything mortgage and real estate related, do me a favor and hit that subscribe button. Now, it's important to understand when talking about debt to income ratios, there are 2 different ratios that we have to factor in here. There's a front end ratio and there's a back end ratio. The front end ratio is your housing expenses, the proposed housing expenses, anything that's going to show up with regards to the mortgage payment on the home that you're buying. So for example, it's going to be things like the principal and interest payment. It's going to be the property taxes. It's going to be your homeowner's insurance. It's going to be things like an HOA if there's an HOA. If you're getting an FHA loan, there's mortgage insurance. All of that is factored in to your actual housing expenses. So that is your front end ratio. And with FHA, that front end ratio needs to stay under 47%. But the nice thing is they'll allow you to take your back end ratio as high as 57%. But something I want to be very, very clear on in this video, just because you keep your front end ratio at 47% and your back end ratio under 57% doesn't necessarily mean you're going to meet the guidelines to get approved for an FHA loan. Once you start getting towards the higher end of these ratios, FHA likes to see things like compensating factors, things like better credit scores, maybe some money in the bank. And you might be watching this going, well, Jeb, FHA allows you to have a 580 credit score with as little as a 3.5% down payment. So if I have the 580 and I have the 3.5% down payment and I'm meeting that front end ratio and that back end ratio, why aren't I getting approved? Well, it's simply because those are really just the basic guidelines. Those are the things that you need to have in order to even consider being approved for an FHA loan. But if you just have the bare minimum across the board and you're maxed out on this debt to income ratio, chances are you're going to have a very, very difficult time getting approved. In fact, the better your credit scores, the more likely you are to get approved with these higher end ratios that we're talking about in today's video. So when it comes to buying a home, don't just try to skate through with the bare minimum qualifications. Actually work on some of these things like your credit score, because it can have a big impact not only on the mortgage rate, which is going to impact your monthly payment, but it's also going to ultimately impact how much home you can afford to purchase, because that lower interest rate and lower monthly mortgage payment is going to translate into having a lower debt to income ratio, which in theory would allow you to buy more home. And this is ultimately how lenders determine how much home you can afford to purchase, because what they're going to do is they're going to calculate your income, they're going to look at your monthly debts, and we're going to do this calculation here in just a minute, and that's going to give them the ratio that when they plug in a certain house price, they're going to see if those numbers actually meet the guidelines. And if they do, maybe there's a possibility to go higher on that purchase price, and if they don't, then maybe you have to go lower in purchase price and or pay off some debts in order to maximize that debt to income ratio. And that's why your debt to income ratio is so very important. But let's take a minute here and do a simple calculation on debt to income ratio. But when I do these videos, I like to be very upfront about this. These videos are just for novelty purposes. If you do these calculations at home, don't use them as the gospel and go run with them and go try to buy a home without actually going through the pre-approval process. The pre-approval process requires you to submit paperwork like your W-2s, like your most recent pay stubs, along with asset account statements, all of these different documents that allows the lender to look at them and do the calculations that we're doing here to verify that you're actually approved to buy a home. Whereas if you're just getting a pre-qualification, you can call somebody on the phone and tell them all these numbers, but if they're not actually looking at the documents, then unfortunately you don't have a pre-approval, you have a pre-qualification, which at the end of the day is worth absolutely nothing. So go through the pre-approval process, submit your documentation, and let a lender look at your income, because it can be difficult to calculate in many cases. It can be much more than just taking that gross monthly income and dividing it by 12, because there could be some other things in there that need to be factored in when trying to calculate these numbers. And when it comes to self-employed borrowers, you should absolutely not try to do this at all, because there are so many different calculations that a lender uses when looking at your expenses that are being taken out that can possibly be added in or aren't being factored in at all that can affect that number. So go through the pre-approval process just to verify that this information is accurate before you go out there and start shopping for a home. Now, if you're watching this video going, where do I start? Well, I created a referral link in the description below of people I know, like, and trust that can guide you through that process. It's free, and if nothing else, just use it as a comparison to the other lenders that you're talking to. And if you decide to move forward, then at least you'll know you're in good hands. But let's take a minute here and do a simple calculation with debt to income ratio. Now, we talked earlier that we're going to use an annual salary of $120,000. Well, that's our gross salary, so we're going to divide that by 12, which is going to give us $10,000 per month. So that's our income in this calculation. But now we have to figure out what that front end ratio and that back end ratio is. Now, I'm just going to have to make up some stuff for today's video in order to give us some examples, but let's say that our mortgage payment with the principal, interest, and the mortgage insurance, because it's an FHA loan, is $3,500. Let's say that includes all of that calculation, but then let's say on top of it, you have $500 in property taxes and another $100 in property insurance. So if my calculations are correct, we got $3,500 plus $500 plus $100, so that's $4,100. So we know right now our housing expenses are $4,100. Well, 4,100 divided into 10,000 is 0.41 or 41%. So we know our front end ratio right now is under the max qualifications of 47%. So in this case, those numbers would work. But let's say, for example, we have a $1,000 car payment, we've got 3 credit cards that total $500 per month, and we've got $500 in student loans per month. So that's another $2,000 in debt that shows up on my credit report. So we know our housing expenses was $4,100 per month. Now we've got another $2,000 that shows up on our credit report. Well, if we add that to the $4,100, that's $6,100 per month. So if we take that and divide it into the 10,000, we know that that is 0.61 or 61%. So even though the front end ratio met the guidelines of 47% because it was 41, we haven't met the back end ratio because we're at 61%, and we need to keep that under 57. So in this case, we wouldn't be able to qualify. But let's use that same example. Say we have a $1,000 car payment and we have student loans of $100 a month and we have a couple credit cards that total $200 per month. So in this case, we have another $1,300 in debt that we need to add to that front end ratio to see if we meet the guidelines. So our front end ratio was $4,100. Now we take the $1,300 that we have here, that's what shows up on our credit report, and we add it to the $4,100. So that puts us at $5,400. Well, if we take $5,400, we divide it into 10,000, that gives us 0.54 or 54%. So in this case, we meet the basic guidelines to get approved for an FHA loan. But as I mentioned earlier, just because you meet those doesn't mean you're necessarily going to qualify, because there are other things that the lender looks at, like your employment history, the type of property that you're buying, as well as your credit score. In fact, there are additional requirements outside of that that you need in order to get approved for an FHA loan. Now, if you're wondering what I'm talking about and want more info, do me a favor and check out this video here. But earlier in the video, I asked, how can you maximize these qualifications in order to get approved for the most home? Well, there's really two areas that you can focus on here that get you the most bang for your buck. One is credit score. The higher your credit score, in theory, the lower the rate that you're going to get, which in turn is going to allow you to maximize those debt to income ratio requirements. But the second thing you can do is eliminate debt, because debt to income ratio is what's holding most people back from qualifying for more home. They just have more debt than they have income in order to support that debt when you start adding on the housing expenses and everything else. So if you can eliminate some of that debt, then in turn it can put you in a better position to qualify for more home. Now, in some cases, you might be able to put 10% down on a home versus just the basics of 3.5% when it comes to an FHA loan. But after talking to a lender, you might realize that it makes sense just to put the 3.5% down and take that other 6.5% that you were planning on putting down and use it to pay off some of the debt that you have that will put you in a better position in order to maximize those qualifications. So there's a lot that you can do in order to maximize it. And some of this stuff means that you need to talk to a professional and not just try to figure it out on your own. Now, if you're one of those people that want the guidance instead of trying to figure it out on your own, do me a favor and check that link in the description below. So while I often say in other videos that credit is the most important piece of the home buying process, the next thing that's the most important is really your debt to income ratio, because it affects everything else. Now, earlier in the video, I referenced that link to go figure out the FHA loan requirements, but a lot of people watch videos like this and they say, I make $50,000 a year or $75,000 a year, and they're wondering how much they can afford to purchase using the debt to income calculations that we used in today's video. Well, I actually did a video that went over that in detail, so if you want to know what that looks like and you're wondering exactly how much home you can afford to purchase, do me a favor and check out this video here.